Good afternoon, everybody, and welcome back to the Fintech Nexus weekly news show. My name is Peter Renton, chairman and co-founder of Fintech Nexus, joined as always by my good friend and colleague coming at us from his New York studio. How are you doing, Todd Anderson?
I'm good, Peter. Not too busy of a news week, so
Slow news week. Nothing. I don't know how we're going to somehow stretch it out. To 30
we
minutes.
could talk about the NCAA tournament.
Yes,
Virginia lost to Furman already,
yeah,
so
right. I know. Already upsets happening. And joining us for the first time, Isabel Castro, our esteemed writer here at Fintech Nexus, joining us from Paris. How are you doing, Isabel?
I am very, very good. Happy to be here.
Great. And thanks for staying up late for us.
yes, thank you.
It's all right.
Okay. All jokes aside, what a crazy week. When we had news this time last week, exactly 1 week ago, we were talking about the problems at Silicon Valley Bank. And I think I remember saying, I think they'll be fine.
But I think you and Nick both said that. I was concurring, so it's not like I was saw anything that you guys didn't, but we didn't think that they would collapse it, and definitely not at the speed they did.
Yeah. Well, we didn't know at that time that the outgoing money from Silicon Valley Bank was $1 million a second, thereabouts. So they lost $42 billion of outflow. Not lost, they had outflows on that Thursday. When that's a sizable chunk of their asset base. There's not many banks that can survive that. So it was a Twitter bank run, and we've obviously been covering this. I mean, we were covering it on the weekend. I was at a soccer tournament in Las Vegas with my son, checking my phone at halftime and making sure that the world wasn't falling apart. And then as I was on the plane to get back, we saw the big news from the government that they were going to guarantee all deposits, which I think was essential to avoid a bank run, and they have done that. So I know, Izzy, you've written about this extensively this week, and maybe you could kind of give us your take. And I'd love to also talk about the piece you wrote where the new CEO said that it's business as usual at Silicon Valley Bank today.
Yeah, I mean, I think now some of the panic has subsided somewhat, a little bit, but the damage is done. Basically, the trust is gone. And then when the CEO came on, I mean, he had to say something. And I know that the bank has to keep going because they're looking still for a buyer. But I mean, to tell the people that have just spent the whole weekend that everything is back to normal, they've spent the weekend like biting their nails and going into chaos mode. Yeah, well, it was a little bit interesting, but I think now startups are going to take it upon themselves to kind of de-risk. I think that's what they are doing, and I think we'll probably see that happening over the next, I don't know, it could be less than a week or two, but it could be more. Just them trying to work out ways that they can avoid something like this happening to them in the future and avoid that chaos. I'm really interested to see what happens on the whole investigation side, though.
Right.
Looking into what's going to happen, what happened. Are they going to actually change regulation? Are they going to do anything on that angle, or are they going to kind of pass it off as the misstep of a few individuals?
Right, and then there's also criminal investigations happening. The DOJ is getting involved, and that we don't know if there was any criminal activity. Obviously, we have no idea right now, but that the mere fact they're getting involved is not a good sign.
Yeah,
Todd, what are your thoughts?
I mean, at what point, do you sell stock right before you realize, or they've realized for many, many months how bad their situation was? And now you get news today. I know we'll talk a little bit about First Republic. That the executives did the exact same thing.
Right.
They all took stock out in the previous few weeks after seeing what just happened to Silicon Valley Bank. I know they did it already, but you'd have to think there were signals inside both of these banks that they wanted to cash some stuff out before their stock cratered because of how exposed they were.
I don't think they
And
ever thought. I don't think they ever thought they were going to go out of business. I thought that they probably thought our stock's going to be down 50% when this all gets out. May as well sell some now.
yeah,
And that would be fine if they were operating on publicly available information. Clearly, they were. They had privileged
exactly.
information,
Mm.
and that's where I think it's.
Yeah, I mean, there was some privilege, but I think as Conrad in our webinar said yesterday, you could have found it if you wanted to.
Right. Yeah, that's
So
something I didn't know about.
I'm
The
sure their
footnote.
lawyers are probably going to argue that the information was publicly available the whole time, though
Right.
maybe not as transparent as it should be. I think there are a few things that the speed at which it happened. I think Washington Mutual was 8 days
Yeah.
for 16 billion, and this was 42 billion in 24 hours. So the speed at which it happened was unbelievable. The other thing is that I think we said this on the webinar many times yesterday. I mean, real-time regulation and greater transparency into what realized losses are. And I think Conrad said maybe the loophole didn't play as big of a part, but I still think marking to market and at least showing where they're so exposed would maybe have regulators would have been more keen had it been like right in their face, would have been more keen to keep an eye on what was going on at Silicon Valley Bank a lot earlier than the Twitter bank run started. So I think there's plenty of lessons here, but banking fundamentally I don't think is broken. Obviously, I think they made some fundamental missteps in having so much tied up in longer term securities, but maybe they should have been a bit more balanced. But I mean, some of this is the rate hikes were higher than everyone anticipated as well.
Yeah, higher.
It's
and
not like
faster.
this.
Yeah.
It was this like this simple answer. It's
Yeah, and I think in hindsight they clearly look like idiots for the way they've handled things. But sure, at the time they felt like everything was manageable. They wouldn't have made those decisions if they didn't think it was manageable. They probably figured, yeah, this interest rates are going up, but we can just hold some of this cash to maturity and it won't be a big deal. But anyway, I want to move on to an article I read in the Wall Street Journal this morning, which was really interesting about Goldman Sachs involvement. And, it started in late February where they got wind that they were going to get a downgrade. Their credit rating was going to go down there. So that means the cost for bonds were going to go up. And the Goldman Sachs people, they got involved. They were organizing this fundraise, which we didn't know, we did find out about. But what the Goldman Sachs and Silicon Valley Bank failed to realize was that there was they misread the mood this would change. They misunderstood the world we live in today, where one VC on Twitter can basically take down a bank and in 24 hours. So super interesting. But Goldman did buy $21 billion of portfolio. And Matt Levine this week, I've been reading him. He's just fantastic, been on fire this whole week. He said that because of the way that these bonds operate and something like everyone was fleeing to bonds, to treasuries. And so the price of treasuries actually went up. So Goldman, they bought a $21 billion portfolio, a lot of treasuries and mortgage-backed securities. It went up in value. So
yeah,
they've actually crushed it, the Goldman Sachs people.
I think it's also a good time to talk about like communication at some of these larger banks as well, which have historically been shrouded in a lot of secrecy when it comes to communication. Like you'll see the Jamie Dimons of the world, like, yeah, they're at Davos and whatnot, but that's usually on like wider economic lens stories. And, I think Silicon Valley Bank and Goldman clearly misstepped in, telling everyone about what was going on and trying to raise and then pulling the plug on the fundraise like almost immediately and say we're up for sale. And it just felt like once the train got on that track, even Silicon Valley Bank didn't know what was going to happen next. And instead of call around to try to get $2 billion, $2 billion together to raise capital. They pulled the plug before even calling around the VCs.
Right.
So I think it was just a comedy of errors when it comes to communication and some of the missteps they made. But we're here now.
Yep. So Izzy, I know that you wrote about this, but obviously Silicon Valley Bank have significant operations in the UK, and they were bought by HSBC for the almighty sum of £1. So that was, so tell us a little bit about what's happening across the pond over there when it comes to Silicon Valley Bank.
Yeah, I mean, in the UK, there was a lot of people who put in bids. Some neobanks as well. I think Oak North was one of them.
Well, if it's going for £1,
I know, exactly. I mean, why not? In the end, HSBC was chosen. A couple of people have voiced concern at this, that they will be able to kind of take on SVB UK and preserve what they do for startups. At the end of the day, they chose who they chose, so it's going to pan out how it does. But
well, yeah, it's a better result than they've got here in the US, where they tried to get a sale and no one was willing to buy them.
I mean, they didn't leave it for very long. I guess they couldn't leave it for very long.
They had to solve it here by Sunday night. They couldn't go into Monday, and so they just
there's reporting. I mean, I think it was later. It was after Sunday, but it sounded like there could have been some cobbling together with some PE and VC money. But it also sounded like the government did not want that to be the realistic option right away, at least. And so the only natural answer was to backstop the deposits and at least stop the shock in the system. But you referenced it a little bit, Izzy. I mean, there is a giant hole now in terms of the beyond the core banking services of what SVB does in the startup ecosystem in the US. And
the UK for that matter, but it's much more so in the US.
It's not exactly, I mean, Ryan Gilbert on our webinar said yesterday, I hope there is a coalition of the willing that can take this on, because, there's a lot of stuff that Silicon Valley Bank did. And some of it was risky in a way, but it served a huge purpose.
Yeah, it's going to take, it's going to take years and years, maybe even decades, to rebuild what they were able to do. But I want to move on. But before we do, just a quick note that there was an article in Reuters today. There will be bids for both Silicon Valley Bank and Signature Bank. They'll be taking bids until tomorrow, and then they're going to obviously see which ones are the best bids. Apparently, they have said any acquirer has to give up crypto. That's the rumor. We don't know that for a fact yet. When it comes to Signature Bank, and all potential buyers must have a bank charter.
And didn't one of the congressmen did reference the FDIC point on crypto? So it did come from a congressman, right? That some of that, I know there's rumors about it as well, but he was vocal about that it was quite a point to make that in the requirements of buying the bank to give up crypto, and crypto was not the cause of this.
Anyway, let's move on. I want to move on to First Republic, because that's in the news today. Just 90 minutes before we came on the air, we found out that First Republic has received a capital injection. We have 11 banks. These are the largest banks in the country. Like all of the top 5, in fact, most of the top 10 have gone and put actual deposits into First Republic. So this gives them a lot of firepower if they have redemptions. And not only that, it sends a statement that the banking system is strong. We don't want to have another bank go out of business, and the First Republic is not a small bank. And so they had the FDIC, the OCC, the Fed, and the Treasury all come out with a joint statement saying we've got these 11 banks on board, not costing the taxpayer a penny. They have to hold the money in First Republic for a minimum of 4 months, and it's gonna be apparently there's a $25 billion hole in their hold to maturity bonds. That's the $25 billion in unrealized losses if they had to sell them. This $30 billion more covers that. So Izzy, what are your thoughts?
Well, I think I'm amazed at how quickly this happened.
Yes.
First of all, they announced it today. I think they were talking about it earlier, but
They said it was coming potentially, and then boom, it's done.
Yeah, exactly. I mean, the amount of money that they can raise in such a short time is amazing. I don't know how this will pan out, but I'm worried that I hope they don't, but that they will go the same way, that they might go towards failing. I hope that the industry will be able to prop them up in the same way. But I think the way that they deal with First Republic will kind of determine the panic pulling of deposits. I think the most fundamental thing in this whole thing is people have become aware now of banking practices, more aware than they were.
Yes.
And that's already happened. We can't go back from that.
No.
So
that's a good thing. To have more awareness is a good thing.
Exactly. It is a good thing, but there is a reaction from that, it seems. Mm-hmm. These are practices that have been used in a lot of banks. So we might still see a bit of rollout from that.
I mean, this is on top of the 70 billion that JP Morgan already lent them over the weekend.
Yeah.
So that's 100 billion. 100 billion in the last 5 days. Because JP Morgan backstopped them over the weekend, and this was a consortium even after that fact.
Right. I thought that was just made it available, didn't actually send them the money. They said they could have it if needed, I think it was, wasn't it?
I'm not entirely sure. I forget the full details of that, but still. The only good thing is that, this is not the government. It is the banking industry, probably with some prompts by the Fed and others to, you guys need to step up. But some of this can also be solved by the, access to the Fed, and to backstop and let, to lend against it. And when these, bonds hit maturity, they can obviously pay some of that back, which, helped stem a lot of the crisis as well. When the Fed opened up, I believe it was on Monday, they opened that up, which could have actually saved SVB had they done that immediately on Thursday.
Yep. And so moving on to fintech, and there are a bunch of fintechs that have done actually fairly well out of this. You've got all of the fintechs serving small business, Mercury, North One, Meow. They are opening accounts. They said, interesting, it started Thursday morning of last week, which is when people started taking money out of SVB. They thought, well, a lot of these companies had money in SVB and nowhere else. And so they had to open up new accounts. And so and the good thing about fintechs is can all be done online, can all be done fairly quickly. North One said takes less than 10 minutes. Get an account number in less than 10 minutes that you can use. That's a huge win. And I feel like those in a position to help like these fintechs are doing a great job. What do you think, Todd?
Yeah, I mean, through whatever crisis there is, somebody's always there there's always a windfall for someone. Mm-hmm. But I also think it does enlighten some people who might not have been otherwise enlightened about the options that they might have beyond Silicon Valley Bank. And so I think in some ways there's some good to come out of this. I also think it'll make, a lot of small businesses and small, tech venture-backed tech companies have a better sense of where not only to put their deposits, but there's also a lot of covenants and requirements that if you raise debt through Silicon Valley Bank, you had to require, they required you to keep your funds there.
Right.
And so I think it also makes them more aware of what the after effect implications are if they were to like raise a venture debt round or raise a debt round that, they're a lot more aware today than they were.
Yeah, that mechanism has gone forever, or gone for a long time. People's going to laugh at you if you try and put that in a clause. Yeah, look at Silicon Valley Bank. No, thank you.
Yeah.
No, I think long term this is going to be quite good for fintechs. They're generally better suited to coming up with solutions quickly, which they've had to in this situation. And I think people are going to remember that. I hope they remember that. And I mean, some of the founders that I've been talking to, they have said, like, some of them have been on the receiving end of this, and they've said that they have worked with people now, and they were in the trenches with them at the point where they were in chaos, in crisis, and that goes a long way.
Yeah.
And I think traditionally, incumbent banks have had the upper hand as this kind of, we're the safest. They had the trust, and now maybe the scales are tipping a little bit.
Okay, one more story before we move on to non-Silicon Valley Bank related news. We had the whole thing around Circle, the stable coin, which had, I didn't know this, $3.3 billion in reserves held at Silicon Valley Bank. So they lost the dollar peg. They went down to like mid-80s, I think was low, back to $1 now. But another big winner out of this is Tether. USDT now is at 75 billion, roughly double what Circle is at right now, as far as the whole market cap. So Tether, another big winner. Circle not doing all that. I mean, struggling with. At least they've made it back. Circle have always been more transparent than Tether, but clearly they had a rough week with the Silicon Valley Bank debacle.
Yeah, this is really disconcerting for me. Like, personally, I find this really, really quite concerning. There's so much vagueness around Tether's reserves and everything to do with them.
Yep.
And just in general, I think one coin, we've seen a couple of coins kind of lose their peg, and I mean, we had Terra last year. I think one coin having so much market cap it's worrying. And I think what's really important now is the regulation of stablecoins. They need to be the regulation needs to focus on them in crypto, because people are putting a lot of trust in them, and now specifically one which isn't very transparent, and I mean, it's setting it up for disaster, really.
I mean, this is why the whole FDIC aspect of you have to get rid of crypto is in part so maddening, because they should be, regulators and bankers alike should be embracing some of this to better understand and de-risk some of this. Even the lessons of what happened with SVB, better understand, and maybe it helps them de-risk a little bit. I don't think it's a fundamental banking problem, but still, I mean, there's still things they can do to better assess risk on their balance sheets. But and I fear that there's going to be such an over regulatory attitude and posture that I think crypto is going to be set back a number of years, even though it had nothing core to do with the crisis that we are kind of still in the midst of.
Right. Well, keep in mind, setbacks a few years in this country. Not every country is going to be like this. So, but this is the biggest market in the world, so it's going to have an impact. Anyway, non Silicon Valley Bank related news. Stripe on an ordinary week, this would be our number one story, right? But this is obviously not been an ordinary week. Stripe raises $6.5 billion. I have to think that's the largest private fintech funding round ever. I can't think of anything else over two, but $6.5 billion funding round at a $50 billion valuation. So they're down from their $95 billion valuation that was 2 years ago. Everyone knew they were going down. I think basically a less than 50% drop is a win, I would say. What do you think, Todd?
Yeah, I 100 percent agree that there was a drop in valuation. Everyone knew that was coming, and I'm sure it hurts some of the investors depending on when they got into Stripe. But the fact that they were able to cobble together over $6 billion is still an achievement in today's market.
Particularly today, yeah.
Thankfully for them, at least, they weren't in the midst of fundraising when the current crisis happened. I don't know how big of an impact that might have had. but I would suspect it would have had an impact. And I think they probably just wrapped up before it happened. So, but still, it's a feat that they should get a lot of credit for, regardless of the valuation, in my mind.
Yep. Izzy?
Yeah, I mean, it just shows that investors are super confident that they are gonna go on to bigger and better things. And I mean, why not? They're a big player in what they do, and I don't want to say anything that's going to jinx them, but they've got no reason not to think that, even though the current situation, the current context isn't to their favor, and they have lost a bit of valuation.
The real question is, where do they put the 6.5 billion?
Well, that's the thing. This is interesting. This is interesting because it's non-dilutive capital, which means it didn't dilute out any of the previous investors, because this capital was used for reimburse, like basically all the employees that wanted to sell, past employees that have been wanting to sell for ages, they all got to sell. And then they also had there was new shares offered, but apparently the new shares, there's only the same amount of new shares issued as shares that were sold, so it was a wash. And then they had to pay tax. They had to pay a big tax bill. So we knew that. I think the tax bill was like $2 billion. So they've certainly got more around that. And then just last before we move on, what an A-list of investors, not surprising for Stripe. A16Z, Founders Fund, Goldman, Temasek. I mean, these are A list investors that sort of provided this capital. So anyway, another thing that happened this week, FedNow finally announced their timing. They said last year they were going to launch. The Federal Reserve said FedNow would launch between May and July. We now know it is going to be in July. This is a big deal. And, there's been running a pilot since September, 120 participants, many banks, including several fintechs participating in that. And they're going to start sort of a certification program, whatever that means, next month. And I'm excited because this is the biggest development in payments in this country for a long time.
Yep. I mean, we need faster payments here. And I mean, there's many people who think the government should provide the payment rails.
Yep.
And, whether or not that's, the case with everyone, is certainly not true. But, the world we live in, we shouldn't have to wait for settlement for like 3 to 5 days. I think it's just ridiculous.
It is.
So, I mean, money should be able to go somewhere and it should be settled, if not instantaneously, really, really quickly.
Mm-hmm.
Yeah, it's just exciting that payments and stuff like that is finally getting to the same level as everyone else.
Right. Yeah. The rest of the world. I mean, Australia's had instant payments for, I don't know, almost 20 years, I think. And so the UK has had it since like 2008, I think, isn't it? Something like that.
Yeah, it's been a while.
But there's incentives in the system to not allow for instant payments.
Right. The whole thing. It's been, it's still we're still operating as if we use paper. And that's the part of the whole thing. That this whole system was built for a paper-based system, but we removed the paper and we didn't remove a lot of the infrastructure.
And it cuts down on fraud.
Yeah. Mm-hmm. So anyway, before we close, I've got to share this note from our esteemed leader here, Bo Bruskern. This is from our previous conversation. Regulators and lawmakers, if you don't understand banking and crypto, not one or the other, but both, please get your hands off the wheel and let someone else drive. Yes, wholeheartedly.
I agree.
If wishing made it true.
Yes, indeed. Anyway, we're going to have to leave it there. Izzy, thank you for joining us for the first time. You did great. Todd, thank you as always. Thank you to you, the watcher or listener. Appreciate your attention. Before we go, though, quick reminder, Fintech Nexus USA happening in New York City, May 10th and 11th. Today is a price break, or this week is a price break week, which means at midnight tomorrow night, price is going up. So if you're thinking about buying a ticket and haven't done so yet, do so today.
Midnight.
Do it today. Don't wait till tomorrow because it's going to go up in price, and just you save $600.
It go up when the clock strikes midnight on Saturday. They go up.
Oh, it is? Okay. Well,
Yeah.
we still
So
got-
tomorrow you can buy tickets at the discount up until 11:59 p.m. Friday night.
Okay, great. With that, we will be back same time next week. Have a great weekend, everybody. See ya.